Thank you again for tuning in to our retirement education concept videos, where we try to provide you with unbiased advice to help you maximize your retirement income. Now, on our channel, we do not believe in giving you some type of silver bullet strategy, or we don't try to glorify any type of one financial product. That is not what we do here. But what we will do is give you holistic concepts that will help you retire with confidence. Did you know that you could actually be double taxed on your IRA distribution, your traditional IRAs? If you did not know this, you're going to definitely want to stay locked into this video today, as we are going to discuss how you can actually be taxed twice if you're not careful, if you don't know the rules, on your IRA distributions. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrew, because with so many retirement concepts out there and so many retirement strategies, and of course, so many retirement products, it can become very difficult for consumers to digest it all. That is why we're so fortunate to work with a team of expert financial advisors to help us build a financial roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, IRAs just have so many rules that it can be intimidating to people to follow when they're just trying to save money and secure a nest egg.
You're right, Andrea. You know, that's what most people are trying to do when they are doing the right thing. They're just trying to save money. And they don't understand all of these rules and stipulations that the IRS has actually put on these retirement accounts. So that's why it's always incumbent, Andrea, on those of you who are watching these videos to always seek professional financial help as it pertains to your retirement information. Now, today's topic, oddly enough, came from someone in our comment section about being confused on the fact that they can have after-tax dollars in their IRA. They didn't understand how that was possible. Now, I know if this individual, Andrea, had questions about having after-tax dollars in their IRA, there are literally millions of other people who would have the exact same question. So we decided that we would do a retirement concept video about this topic so you can really understand the ramifications of not knowing that you can be taxed twice on your IRA distributions. And so we're going to cover this in today's short educational concept video. But before we do, there are always two rules to retirement income that we like to give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one. All
right, so let's go ahead and talk about how you can avoid being taxed twice on your IRA distributions.
So Carson, no one wants to pay twice on the same dollar. How is that possible with IRAs?
Yeah, this is something that many people may not be aware of, but you don't need to be frustrated. You can be educated right here. The first thing when it comes to understanding the ideal of making what we call a non-deductible traditional IRA contributions, one of the things, let's just get some quick notes here so people can understand how an IRA works. You have to have income from W-2 or self-employment income in order to contribute to an IRA. And of course, the maximum amount that you can put in 2022 is $6,000 if you're under the age of 50. And if you're 50 and older, you can put in an additional $1,000 as a catch-up. So for a total of $7,000. But you do have to have earned income in order to contribute to that IRA. Now, a lot of people may say, well, what if I want to contribute to a Roth IRA? And so how do we get into this non-deductible after-tax dollars going into a traditional IRA? Well, the problem is that there are income limits when it comes to contributing to a Roth IRA, unfortunately. So if you're single, Andrew, you make more than $144,000 a year, you can no longer contribute to a Roth IRA. If you're married, and your joint income is over $214,000 a year, you can no longer contribute to a Roth IRA. Obviously, when that happens, that's going to lead people into funding a traditional IRA. Now, when you fund this traditional IRA, you can deduct that income from your taxes. But there is a phase out range that you have to pay attention to. And when you hit that phase out range, that is when you can end up having after-tax contributions to that traditional IRA. So I want you to take a look at the chart that I'm going to share with you so you can clearly see the phase-out range and how this may be appropriate when we're talking about non-deductible contributions to a traditional IRA. Take a look at the chart here. So as you can see from the chart that we have on our screen here, if you're single or head of household, if you earn less than $68,000 in 2022, you can have a full deduction of your contributions. Now, this is for someone who is covered by an employer-sponsored plan. I need to make this note very clear. This is if you're covered by an employer-sponsored plan. If you're not covered by an employer-sponsored plan, no matter how much income you make, you can deduct that contributions from that traditional IRA. Keep that in mind. But if you're single and you have a workplace plan, if you make less than $68,000 a year, you can make a full deduction from that IRA. If you make more than $78,000 a year as a single person, you can no longer make deductible contributions from that IRA. You can also see as we move down the chart, if you're married filing jointly and you're covered by an employer-sponsored plan, that's you and your spouse, if you make less than $109,000 a year, you can have a full contribution of that IRA and have a full deduction of that contribution. Now, if you make more than $129,000 and both you and your spouse are covered by a workplace plan, there is no deduction. So that means that you will be making a contribution to your IRA as an after-tax non-deductible contribution to that IRA. Now, there are increased limits for a married filing jointly couple. As you can see, we made this notation on the screen as well. If you are a married filing jointly couple and only one of you are covered by an employer plan, that means just one, the other spouse is not, you can see that your income limits are much higher. If you make $204,000 or less, you can have a full deduction of that contribution from that traditional IRA. Now, if you make more than $214,000, that is when you phase out and you're going to have to make after-tax contributions to your traditional IRA. So now that we got that understood, let's go ahead and complete this discussion and understand how you can be double taxed on this money. So from the chart, you can see that those are the ranges that you can get into where you're going to actually end up making after-tax contributions to a traditional IRA. Now, you have to take this very seriously because if you don't want to be taxed twice on this money, you're going to have to keep up with it yourself. There is a tax form, an Irs Tax Form 8606 is what you're going to have to file to let the IRS know what your cost basis or what the original amount that you funded that traditional IRA was. Now, unfortunately, your custodian that you may have that IRA with will not keep up with that information for you. You're going to have to let the IRS know that this is what I funded my after-tax traditional IRA with through Form 8606 in order to make sure you keep good records and not be taxed twice on the same dollar amount. Now, what you can do with an after-tax contributions to your traditional IRA, Andrea, you can actually convert that to a Roth IRA. You can do that. Roth IRA conversions are very commonplace for those who actually contribute after-tax dollars to a traditional IRA. Now, one of the things that you're just going to have to be conscious of is that if you do that, you may be subjected to what they call the Rata Rule. Okay? If you have other pre-tax traditional IRAs that you funded, meaning that you were able to deduct those contributions at one point or another, and you now have after-tax contributions, they call this what is known as the cream in the coffee scenario. Once you put the cream in the coffee, we love coffee, by the way, we try not to drink it every day, but once you do put the cream in the coffee, you just can't separate it. That is the same idea when it comes to the pro rata rule, when you're actually dealing with a Roth conversion of a after-tax traditional IRA. If you have other IRAs, they're going to look at your total amount of IRAs that you have, and when you decide to take a distribution from that traditional IRA, there's only a certain percentage of that money that will be tax-free. So I want you to take a look at this chart that I want to share with you so you can really understand how this works. So if you take a look at this slide here, let's take a look at this slide. Now you have a non-deductible traditional IRA that you funded, after tax dollars, that has $50,000 in that non-deductible traditional IRA. But you're also looking in the same year to roll over a 401k to an IRA, and that's going to be valued at $400,000. Now, at the end of the year, 12/31/2022, the value of your IRAs for, we're going to keep things simple here, was still $450,000. But you're wanting to take now a $50,000 distribution from your after-tax traditional IRA, and you're thinking this is going to come out tax-free. But that is not what is going to take place here. Take a look at the chart. So you want to take this $50,000 from your after-tax non-deductible traditional IRA. What they're going to do and how the IRS calculate the pro rata rules, they're going to take a look at all of your IRAs now, a total. So they're going to take that $50,000 and they're going to divide it by the total amount of your IRAs, which is $450,000. So when you divide that $50,000 into the total amount of your IRAs now of $450,000, that comes out to 11%. And what they're going to do, they're going to take that 11% and multiply that by $50,000, your distribution amount. And as you can see on the chart, the only amount that's going to be tax-free from that $50,000 now is only $5,556. So when you look at what we just showed you on the chart there, one of the things that we would advise our clients to do in any year, they have an after-tax contribution of an IRA, and they're going to roll over their 401k in that same year, and they're planning on taking a distribution, we are going to advise them to wait until the following year. Go ahead and take your distribution from that after-tax IRA, because that's the only amount that's going to be calculated in your distribution at that point. That means that all of that money can then be tax-free to you, and you can wait until the next year to roll that 401k over into an IRA, and it will not affect that distribution. So just very smart planning strategies can really help you avoid this double taxation, and it'll help you avoid the pro rata situation as well. So I really hope that the information shared in this video today was beneficial for those of you who may not understand, quite frankly, about how you can be double taxed on your distributions from your traditional IRAs. Please remember that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. And also, if you're looking for a fiduciary financial advisor to help you with these type of complex financial matters, we highly encourage you to click on the link provided in the description below and go ahead and schedule a free complimentary consultation with us today, and find out if you qualify for a complimentary financial plan.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.